As we enter 2021, the market's recent bout of festive cheer will have left many investors feeling upbeat. However, do not allow yourself to be carried away by the market's high spirits. There are many reasons to feel positive about the year ahead. It's equally important to note what markets seem to have forgotten, namely that the pandemic and its consequences are not yet behind us. Joining us in conversation to share his insights on whether South Africa could see itself slaying its fiscal demons, as well as to highlight a few global trends for the 2021 fiscal calendar, is Chief Economist and Advisory Partner at Citadel, Maarten Ackerman. Maarten, good evening and thank you so much for your time.
Thank you. Good evening.
Notwithstanding COVID-19, how have the markets in fact entered the first quarter of 2021? Are they buoyed by developments in the US with the election results, or possibly also by the vaccine rollout taking place in certain countries?
Yeah, I think what we saw at the back end of last year, that festive spirit is definitely continuing into the first part of this year. If you just think about the local market, we've probably seen a rebound so far year to date, which is in line with a return that you would expect for the whole year altogether. So there's definitely still a lot of that momentum in the market, and I guess it's still likely to continue for a little bit longer. So yeah, that trend certainly haven't stopped yet.
Yet, at the same time, as we're well aware, businesses and households remained under severe pressure. Is there a disconnect?
No, certainly. There's a massive disconnect between what markets are telling us at the moment and what's really happening on the ground. If you think about 2020, and if you were sitting on a different planet and you didn't know anything about COVID, then you would probably look at the year and say, but this seems like a good year because all markets are up in double digits. The currency locally is much stronger. So you would argue and say whatever the COVID thing is that they're battling with on planet Earth is actually, it seems like it's a good thing because everything's up. And I think that's where the disconnect lies. So markets are definitely running ahead rather from what's happening on the ground. There's a couple of reasons for that. Certainly the amount of stimulation or stimulus that we saw across the world from middle of last year. And you can add to that the hope or the positive feeling around the vaccine. But unfortunately, the reality is that, the vaccine will take probably the best part of 2 to 3 years to reach all parts of planet Earth. We might see it being rolling out fast in the West, but other parts will take much longer. And even if everybody wakes up tomorrow and we've got the shot and the virus is under control, the economic damage is still with us and it's likely to remain with us a little bit longer. So a long story, but at the moment there's still about 10 million people in the US, as an example, that lost their jobs. Today, again, we saw some employment numbers from the state that show that close to 1 million again filed for unemployment. So, that's the underlying fundamentals that we talk about in an environment where economies are struggling, companies are struggling. There's potentially more layoffs. Locally, we're in a second kind of tighter lockdown. That keeps the economy under pressure, yet the markets are telling us that everything is rosy. And that's why we are talking about this major disconnect between what markets are telling us and what's actually happening on the ground.
What are the implications of this disconnect, Maarten?
Well, technically you would argue that the market at some point will need to reflect what is happening on the ground, which implies that markets can't stay at these levels, and we're likely to see quite a strong pullback in markets. But this time around, we are almost fighting the tide of liquidity which all the central banks are providing. So if central banks continue to provide this kind of stimulus, whether it's like COVID relief packages for households or cheap credit for companies, that paves the way for markets to hang around these levels without a real reason to pull back strongly. until we do get the economic recovery, which will happen in time. I think the recovery is already underway, but it will take a bit of time to get back to full capacity. And until, the vaccine provides herd immunity for the global population. But the risk is that, if any of those things wobble, so central banks don't have the ability to further provide liquidity, or we pick up or realize that the vaccine is probably not as effective as everybody's hoping, and it's maybe slower in terms of rolling it out. Those kind of things can definitely make markets to wobble and then pull back from these current levels.
Do you expect, with the role of the central banks providing that stimulus as you described there, Maarten, do you expect that interest rates will continue to fall?
Well, I think in the West, we probably, for many of them, at zero, in some of them even negative rates. So we're certainly at the end of the road in the West. They can't really do much more from interest rate policy.
I see.
They will do other things like, this quantitative easing or fiscal support. That's definitely likely to continue. Also, I guess, this year we're not see any normalization of interest rates. So it's very unlikely that we will see that rates are moving higher. Locally, pretty much the same story. We might still see an interest rate cut. There is still some room for that. But our rates are also at historic lows. And I guess if we don't see a cut, at least we'll be in a holding pattern for quite some time, so that the economy can start to recover before we will start to see any increases in interest rates. So I guess the consumer out there can at least rest assured that it's unlikely that you'll pay more on your loans this year. And it will take a number of months going into next year before we'll probably see an interest rate increase.
Maarten Ackerman is Chief Economist and Advisory Partner at Citadel, and he joins us in conversation this evening on The Honest Truth. Maarten, is there also an expected impact from the second wave as well? Have the markets factored this in?
Yeah, the second wave in the West, definitely we saw softer economic data, but again, it's as if markets are just ignoring that and say, well, that's a temporary thing, and the vaccine will soon bring some normality back. In terms of the SA story, we basically started with our second wave and more severe lockdowns in middle of December. You could probably argue that the rand showed a little bit concern because the rand ended the year very strong, and since then the rand weakened a little bit, although the global factors are still very much supportive for emerging market currencies. So the rand could tell us a little bit about a concern that, us going into another lockdown is bad news for potential economic growth. That is bad news for government to collect more taxes, and with our fiscal situation already under pressure, somewhere we will need to see an adjustment in some of the asset valuations, whether it's our bond market or then, on the other hand, the currency. So the rand reflected some of that, but not, we're talking about a couple of cents in terms of the movement, so it's not a massive move. But yes, you're right, the second wave, will be less severe than the first because we haven't seen full lockdowns. It's more regional, it's less strict, but it's definitely going to cause a soft patch and probably a little bit of a delay in the economic recovery that started probably in the second half of last year.
Speaking about that delay in economic recovery, and you referenced unemployment numbers, some of the latest figures coming out of areas such as the US, but both globally and locally here in South Africa, what sort of impacts will the unemployment levels have on the recovery of the economy?
I think that is actually the root issue that needs to be addressed. The economy can only recover if everybody get back a job, earn an income, and is in a position to go and spend that and support companies and company earnings.
Right.
Where we are right now around the world, we are seeing still an increase in unemployment, and I don't think yet, even if the economy is slowly recovering, there's still a lot of companies that now realize that yes, things are difficult, and then they decide to lay off maybe one or two more people. So we still see an increase in permanent unemployment. In fact, if you look at 2008, after the financial crisis, unemployment only peaked 2 years after the crisis. And I guess we're in a similar kind of environment right now. So as long as unemployment keeps going up, that's a major headwind for spending in the economy, for companies to obviously benefit from that spending, and then for the economy to continue to grow. So that will definitely contribute to a slower recovery. It won't end the recovery, but it will definitely be a massive headwind. And this time around, we are very much concerned about what we call structural unemployment. So there's definitely some people that lost their jobs. And even if the economy gets back to full capacity, they won't get back their old jobs because there's been structural changes. Some example is what's been happening in the airline industry. I think the full capacity in the airline industry is going to look very different going forward. People will travel less, even if it's safe again. A lot of business meetings will happen via cyberspace. So, probably 20-30% of people that work in the airline industry, those jobs are lost forever. And they will need to reskill and find something else to be employed. And that normally takes longer to get that people back in the job market. So all of those will contribute to the recovery taking a little bit longer than I think most people hope or expect at this point in time.
Maarten Ackerman is Chief Economist and Advisory Partner at Citadel, and he joins us in conversation this evening on The Honest Truth. Does that mean that from a South African point of view, Maarten, that it becomes absolutely critical? So much has been spoken around these expected structural economic reforms that in hoping to provide extra stimulus to our economy, that needs to be attended to sooner rather than later.
Yes, I think this is the make or break year for SA. We've been talking, for the last couple of years. COVID probably just made it much more urgent to realize that we can't wait any longer. We can't really let political gridlock prevent us from doing some of these reforms. Because the reality is, if we don't see proper implementation in SA this year, then the fiscal cliff or the debt crisis that the Minister of Finance talks about will very quickly become a reality. And that's something that we definitely would like to avoid. So I think the silver bullet for SA in 2021 is not just to roll out as much of the vaccine as we can, but to definitely make sure that we make the right changes so that as the global economy rebounds, we can also benefit from that, and that there's no more structural hurdles that keep us back compared to the last decade where we haven't benefited from the strong global economic recovery. In fact, while the global economy went forward, we slowly started to decline into this last decade that we all refer to.
And what are some of the key changes that you would like to see happen, Maarten?
Well, I think it's everything that the government is talking about, but it's the move from the talking to the doing that's so important. So there's a lot of talk about on the SVs putting in private partnership. That's something that we haven't heard about or probably wouldn't have talked about a couple of years ago. Those kind of partnerships in this SOE space will make a huge difference in terms of improving efficiencies. We are seeing progress on all the corruption charges. Maybe some people expect it to be faster, but if you imagine where we've been and where we are right now, it takes some time to actually turn that kind of ship. And then for the economy specific, it is basically things like ease of doing business, ease of registering a new business, dealing with labor, filing your taxes, getting access to credit. So it is a little bit of red tape that the government can very easily address and remove that will just create a much more business-friendly environment. And as soon as we can do that, I think the economy can get some proper traction.
Lastly, Maarten, despite the challenges, what are the opportunities for investors both abroad and in South Africa?
Yeah, I think there's always opportunities despite markets being at these levels. If you think about good quality companies, locally and abroad, companies that's well positioned for the new world. The world's changing very quickly. Companies that's ready for the fourth industrial revolution. So you talk about, cyber meetings. You talk about biotech, medical research. If you buy those kind of companies, then you know, despite markets being at these levels, despite potentially market volatility, that is probably the only investment that in the next 5 to 10 years will be able to still preserve and create wealth. Because remember, those companies that can survive, they have pricing power, and then in time you also see that in earnings. Compare that to, you know, just leaving your money in the bank in the US as a start, you earn nothing. So you're not going to go anywhere. In fact, with that a little bit of interest rate, it will take you more than 100 years to double your investment. So you need to take some risk to make some money. And even locally, you know, our interest rates are not that low, you know, but still after cost, inflation, and if you pay tax, you're probably not going to move forward just sitting with your money in the bank. So taking some risk makes sense. But then if you do have the option, again, I think a little bit more global equity makes sense. There are some SA equity that's well positioned. But until we see the reforms that we just spoke about, I think a lot of the local SA companies, in other words, those companies that only operate within our borders and make money from local consumers, they will still probably struggle a little bit. And therefore, it's probably better to tilt your portfolio towards those companies locally that have a little bit more of an international flavor in it as well. So yeah, I think to wrap up, probably a core global flavored kind of quality equity portfolio. And then if you want to reduce your risk, I think the old traditional asset classes like government bonds and cash is not going to do that in this environment. So one can probably look at things like combination of gold, some other currencies, and other alternatives that can provide you that with that lower volatility exposure.
Maarten Ackerman is Chief Economist and Advisory Partner at Citadel. Appreciate your time, Maarten. Thank you so much for joining us this evening.
Thank you very much. Much appreciated.